Hi everyone, this is Jason Burack of Wall Street from Main Street. Welcome back to another Wall Street from Main Street podcast interview. Today's special guest is a returning guest. I've had him on I try to have him on every couple months. He's a gold fund manager. He worked on Wall Street trading bonds, and he's also the proprietor of the website Investment Research Dynamics. Thank you for joining us again, Dave Kranzler.
Hey Jason, thanks for having me. Always fun chatting with you.
Yeah, it's always fun getting your insights, Dave. And we just had a major news story today about the Swiss central bank pulling the euro peg. You told me before we started recording you have an interesting theory on this. I spoke with Willem Middelkoop, though, for a little color for our listeners. He wrote the book, The Big Reset. We're going to try to get him on for a podcast. He predicted a lot of the financial crises over the last 8 years. He's European. He's Dutch. He thinks that the Swiss central bankers think that the European Central Bank is going to start printing money now. They're going to violate, their mandate. They're going to piss off Germany, and they're just going to start printing massive amounts of euros to protect their European banks. What's your thoughts on this?
We were chatting about that really quickly before you turned on the tape recorder, but because I hadn't really put a lot of thought yet into what the Swiss did, but I think he might be right. I think that's right, I do think that I think the SNB and the powers that be in Switzerland were worried about more money printing coming from the EU, and they were worried about the value of their own currency given the peg, and so I think Middelkoop's theory makes a lot of sense. Now, my interesting theory didn't relate directly to the Swiss peg per se, but it ties into it. And that was, I asked you, I said, it makes sense, except can the ECB print without Germany rubber stamping it? And I don't think they can. However, I was actually just thinking about this, it was either yesterday, I think. I wonder to what extent Germany coming out and saying that they won't sign off on more printing, I almost think that could be political job owning, that the powers that be in Germany, that Merkel is taking that stance just to placate the population there, because we know the general population over there hates the fact that Germany's subsidizing the Club Med countries over in Europe. And the German population over there, they're going to go ballistic when they find out Germany's gold is leased out. So I'm almost wondering if Merkel's stance on more printing is really just grandstanding to placate the population over there, and eventually at the last minute they'll throw in the towel. And that's what I think's going on there. And to me, that idea kind of ties into what Middelkoop is thinking in terms of the SNB officials getting wind that the ECB is getting ready to print a lot more money, which I think they have to, or else that system's going to collapse, which it will anyway. But that's a story for another day.
Yeah, and we're also in currency wars here, because everyone's a Keynesian central banker. They're using mercantilist policies. The euro's gotten way too strong against the dollar in the past for the euro's liking. They want to boost their exports. And to add to your point there about the German citizens, the German citizens, they have their vote, but there's the special interest groups in Germany, the large German corporations, the exporters, they don't care if the German citizens may be subsidizing some of these poor European countries that don't work as hard as Germans do, because they're getting extra profits there from a weaker euro. So if you're Mercedes, Benz, or or BMW or some of these larger German export giants, you probably want a weaker euro. But there's also the possibility. And I think there was even a couple European countries, I'm not sure if Germany was one of them, but after 2008 there was a couple of European countries we found out through Zero Hedge and other sources that actually printed their own currency again and had, a contingency plan in place just in case they were going to leave the euro or the euro broke up. So, I guess it's a fluid situation, Dave, and there's a lot of things going on behind the scenes that we may or may not ever find out.
Oh, no question about it. Well, we'll find out when we find out.
Yeah. If they decide, they only tell the truth if it's convenient. I think that's the best way to describe government in general, right? They don't like telling the truth most of the time, but if it's really convenient for them, then they'll tell the truth.
Yep, and it's getting to be more and more inconvenient.
Well, speaking of convenient lies, I want to talk about the statistics in the economy. You cover the housing market and the economy right now. We're starting to see, according to your articles on your website, Investment Research Dynamics, you have special reports out too on the housing market. We're starting to see the housing market slow down. I live right outside of D.C. My real estate agent contacts here tell me the market's starting to slow down. There's starting to be an oversupply. Houses are not selling as fast as they used to. They're sitting on the market faster, and yet, builders are continuing to build more high-end luxury condos, more very large, over $1 million single-family homes further and further away from D.C., and it's not just that way in this market. It's that way in so many markets. What's your opinion of the housing market right now?
Well, my opinion of the housing market hasn't changed since January 2013, which is when I came out and I said it's going to be a volatile ride up and down, but you got to short the housing market now. And the data shows when you and I write about this all the time. I've got articles on Seeking Alpha and on my blog. When you take the National Association of Realtors data, or you take the Census Bureau data and you strip out all the statistical Mickey Mouse that they pile into it, essentially, when you look at the year-over-year monthly comparison, so say, the next numbers that we're going to get are December home sales, existing and new homes. When you look at December 2014 sales with December 2013 sales. So you look at it on a monthly year-over-year comparison basis, because that washes out the seasonality. We've been in a pretty well-defined downtrend in terms of unit volume ever since July of 2013. And not every year-over-year monthly comparison has been negative, but most of them have been. In fact, I think the existing home sales metric was negative something like 9 or 10 months in a row before it finally had a bounce. And I think that was a BS statistical adjustment bounce. I don't think it was a real bounce.
Now, we're starting to see, these gimmick type of programs because I think the market's saturated for a lot of the investor demand for real estate. There's been a lot of capital that's come in over the years, really since 2008 into the United States market from China, from Europe, from other areas, because the U.S. is viewed, I guess, as a safe haven still compared to other areas. But my demographic, Dave, the 25 to 30-something-year-old, we don't have the money to buy, put the down payment down to have the money saved up to 20% to put. And it looks like the government, whether it's Fannie Mae or Freddie Mac, are starting to come out with these, gimmick type of programs now to try to trick people, I guess, into, you don't have to put down the right amount of money. Is that the way things seem? They're desperate to try to keep this bubble going and bubble from bursting, and they're, I think Fannie and Freddie just announced, new standards for lower amounts of down payments and stuff to try to get that first-time home buyer in to buy the market, because that's really the one key metric there where it's not showing any positive growth.
Well, I can't speak as to what their motivation is. It's not going to stimulate the market, and this is the reason why. Fannie and Freddie just rolled out 3% down payment mortgages, and the funny thing is that FHA has been offering 3.5% down payment mortgages since like 2008, when all the subprime mortgage fraudulent brokers went belly up, like Countrywide and Wash Mutual, Wachovia. When they went tits up, FHA stepped in and filled the void for junk mortgages. And so, to give you an example of the impact FHA has had, they're in 2007, I think it was, maybe 2008, FHA was underwriting 2% of the mortgages, and now they're close to 20% of all mortgages underwritten are flipped into the FHA, Federal Housing Authority. So so they've been offering 3.5% down. They've basically been offering the subprime equivalent loans since 2008. So I don't really think that Fannie and Freddie are expanding the audience of the market by taking their down payment requirement to 3%, because there's not really, on a $200,000 home, there's not much difference between a 3.5% or a 3% down payment. So in other words, the market demand for that type of mortgage is saturated. And as you say, basically the under 35 demographic, which is that's primarily your first time buyer demographic. Historically, over a long period of time, the first time buyer has been 40% of the market. Okay? For the last year roughly, the first time buyer has been under 30% of the market, and the home ownership rate for that demographic has plummeted. And the thing of it is, it's like, if you just take a macro view of the population, the average middle class guy, even if he can somehow scrape together enough money for a down payment, they'll even let you get the down payment gifted, which that in of itself is basically a no down payment, a no money down payment, right?
Yeah.
So the middle class demographic as a whole, even if they can figure out how to make the down payment happen, they're not earning enough money to support the cost of home ownership, even if you took mortgage rates down to zero, because you still got to amortize the mortgage every month. You got real estate taxes. You got homeowners insurance. You got maintenance and all those other expenses that go with homeownership. 51% of the country is earning $20 an hour or less. I don't understand how all these guys who are still bullish on housing, either they're just disingenuous and they know about the income data, across the country, or they're just too stupid to figure it out, and they just want to buy into the BS, and they want to promote the BS. When you have 51% of the country earning $20 an hour or less, and that's a number compiled by Goldman Sachs, how in the heck can you support a housing market like that? You can't.
You can barely pay rent. You can't start a family. You can barely pay rent. There's almost no discretionary income.
Exactly. And so what happens is the first-time buyer segment of the market, that's the bread and butter part of the market, because then the next demographic up is your move-up buyer, right? Now, you got the income distribution for the move-up buyer demographic is going to be a lot higher than the first-time buyer demographic, but they still need to be able to sell their existing home in order to buy their move-up home. And how are they going to sell their existing home if the first-time buyer isn't there? So
it's a good point.
Everyone talks about the velocity of money. Well, there's also a velocity of transactions in the housing market. And when you shrink as much as you've shrunk the velocity of the first-time buyer demographic, you're basically it's gonna shrink the entire market.
Well, there's been a lot of foreign capital that's come in and bought American real estate from Asia, China, Europe, you name it.
That's true, but that's been primarily on the West Coast and the East Coast. It's primarily been the trophy properties. And I've been reading accounts recently how essentially the Chinese and the Russians are starting to disappear from the market, and you're starting to see that in Manhattan real estate, where I've read accounts of several extraordinarily high-end buildings that were put up for that purpose to let wealthy Russians launder money. They're sitting empty now. They can't sell them. And so, what's interesting about that, and I get emails from people all over the country telling me they're seeing the same thing. I'm seeing high-end real estate in the Denver metro area. It's starting to pile up like litter in a junkyard. I mean, if you go into any of the real estate listing websites and you just do a filter for home listings for $750,000 or above, I mean, it's just shocking how many homes are on the market.
Yeah, then why are the home builders, Dave? Then why are they still building? Are they using bad accounting? Then why haven't their stocks, cratered yet? Is Congress allowing them to do what they did in 2008, where their accounting, they were given basically some type of bailout?
Well, I've gone over the home builder accounting on the research reports that I have on my website, and I go in depth into the accounting, the misleading accounting these home builders are using. All right, but it's not. I mean, yeah, the numbers are completely phony. To give you an example, KB Homes, which warned yesterday, and they're the ones that really started the avalanche in the home builders yesterday. I mean, KB Homes was down 16% yesterday and down another 9% today. Well, they reported something like $900 million in net income. Well, guess what? $850 million of it roughly, and these are just rough numbers, 90% of their net income reported was a non-cash tax income benefit that they took because they reversed a deferred tax credit, and it allowed and according to GAAP, according to the wide berth that GAAP now gives home builders and actually gives all companies with that particular non-cash income accrual, they were allowed to take this massive reversal of their deferred tax asset, and it created, this $850 million or whatever amount of net income that's not real. It's phony.
Doesn't sound like free cash flow to me.
Exactly. Well, I mean, and no one digs into the home builder numbers, and part of it is because the sector is very heavily shorted. Most of these home builder stocks already have a very high short interest in them, and so it tends to be volatile anyway. And a lot of them, they don't have big share floats, so they're easy to manipulate. But
it's also these trading computers, these high-frequency trading algo computers, they don't look at the numbers like you do, so they just look at the headline that the company reported.
Exactly.
That's why.
But people who think that home builders are cheap aren't looking at the numbers. The home builders are probably the most overvalued they've ever been in history. They're more overvalued now than they were at the peak of the housing bubble. Almost every single one of them has the same amount or more inventory than they had in 2005 and 2006 when the bubble popped. They have the same amount of inventory now than they had then, and their sales unit volume is a third less. In some cases, it's a quarter less. And not only have they built up their inventory, they've all borrowed a ton of money in order to do that.
Sounds like they'll be needing another bailout soon.
The taxpayers aren't going to put up for a bailout of the home builders. I mean, what bailed out the home builders was obviously, the money printing and also the Fed taking interest rates down. And that's another thing. I mean, you've had the 30-year or the 10-year bond has collapsed in yield, and that's part of where your algo traders come in. They say, oh, well, lower yields means more home sales, and so they just blindly go in there and buy these things. Well, guess what? In this particular case, lower yields means the economy is collapsing, and it doesn't mean more home sales. It means all these home builders are going to go belly up. In fact, I have one report for a company on my website, and I know that company is going to hit the wall. They just have way too much debt, and they're not going to be able to service it within the next, 6 to 18 months.
Very good. So for our listeners there who are looking for hedges on the short side, they should definitely check out your reports. Now, Dave, you also, you're a gold fund manager. You pay very close attention to the gold market and gold stocks. We've had you on here to discuss the gold market. What's your opinion of what's going on in the gold market with respect to the European countries, Austria, the Dutch, asking for audits of their gold and or demanding their physical gold back now? Recently?
Well, I think what we're seeing is I think we're starting to see the beginnings of the scramble for physical gold. And I think to me it's an acknowledgement that these countries are implicitly acknowledging that they know that the gold market, the paper gold market, has been a giant Ponzi scheme. It's a giant fractionalized system. And it's one of these things, when the music stops, if you don't have a chair, you got nowhere to sit down, right? And we're talking about, the London market is probably, well, obviously we've all seen the number that it's levered up 100 to 1, 100 ounces of paper gold for every 1 ounce of real physical gold. It may be worse than that. I have a feeling it probably is. And I think you got some of these countries like the Netherlands and Belgium and Austria, and these are all countries that traditionally are like, pretty diehard, gold standard countries. They kind of got sucked into the fiat EU system, but I think there's probably pressure not just within the countries at the upper political levels, but also probably from the citizens to say, hey, go get our gold.
Yeah, and the reserves for some of these countries, especially with Switzerland, they just have so much paper right now, and everyone's in, currency war. They're in a race to debase that, everyone's trying to print money, whether it's Japan, the yen is just blown up, and it looks like the yen's on a collision course. They've got an enormous math problem there just servicing the interest payments on their debt. And the U.S. and the U.S. is not that much behind Europe. So I think really, the gold market, we've been in a bear market, a really ugly one, I guess, for 3 years. But, that shouldn't surprise people because it looks very similar to that cyclical gold bear market from 1974 to 1976. And the sentiment levels for anyone, talking about gold, if you talk to any mainstream people about gold, they just laugh you off. So, and yet I think the gold stocks, right, have been one of the top performers in 2015. So it looks like we've started to build a base. We've started to see, some evidence of positive fundamental activity in the market. We started to see some mergers and acquisitions, things like that. So that's starting to give me hope that I think the bottom is in gold and all the fat's been cut and we're ready to move higher. Not a lot higher in 2015 per se, but like the bear market's over.
Well, I mean, I don't even like to call it a bear market. It's an artificially manipulated market, and it's been artificially manipulated lower since mid-2011 for silver and in September 2011 for gold. And I don't think it's fair to call a market that's under manipulative duress like that to be a bear market. I mean, I think that's sort of a description that Wall Street wants to throw out there so that it denigrates gold, and that gold is anti-Wall Street and Wall Street's anti-gold. So to me, to refer to gold as a bear market is really, it's a pejorative, and it's incorrect. I mean, as everyone knows by now, gold was the second best performing currency in 2014. The only currency it went down against was the dollar, and it didn't even go down that much. For all the hoopla surrounding, the gold bear market and the gold sell-off and, gold is over. Gold was only down about 1% versus the dollar.
That's a good point. And the dollar index was up so much, so gold actually held its own pretty good, and gold was at all-time highs, right, in almost every other currency.
Exactly. So, in the U.S., dollar holders will get theirs when it comes to gold too, because at some point, the guys who are manipulating the gold market, as history has shown, manipulated markets eventually come apart at the seams. And when they do lose control of their ability to keep the price of gold down, I mean, people are going to be shocked at how quickly and how sharply the price of gold goes up priced in dollars.
Yeah, eventually there become shortages in manipulated markets, whether it's, FDR artificially holding the silver price high and all the silver leaving China and coming to the United States, or, the artificially suppressed low gold price when gold was artificially held at 35 and massive amounts of gold, were being smuggled out of the United States into Europe and stuff like that, who knew that FDR was going to devalue the dollar against gold. So, yeah, there is shortages there, and that's how the London gold pool ended, right, on a gold shortage, because people knew the gold price was overtly being manipulated, and people knew that gold was extremely undervalued relative to its artificial paper price.
Well, and everyone scrambled to get physical gold because they knew that at some point they might not be able to. I mean, that's eventually what forced Nixon to close the gold window, right? Because Charles de Gaulle had figured out the math and had figured out that the U.S. had issued more treasuries to foreigners than the U.S. had gold to deliver if all the foreigners had said, okay, right, because that was the Bretton Woods Agreement. Foreign holders of U.S. Treasuries could take their debt certificates and exchange them for gold at the Fed. Well, de Gaulle ran the math on it and said, no, this doesn't add up. There's more treasuries out here than there is gold. I'm going to go get my gold before I don't want to be last in that line, right? And that's why Nixon closed the gold window, because they knew that once de Gaulle did it, everyone else was going to do it, and at some point, you know, most of the people in the line would discover that Mother Hubbard's cupboard was bare. And that's where we are right now, and that's probably another reason why these countries are asking for their gold back. And it's also why, you know, there's movements over in these countries obviously demanding an independent audit of the gold reserves, because just because the Fed says that it's holding 8,100 tons of gold on behalf of the U.S. Treasury in its vaults, I don't know anyone who knows anything about this market that believes most, if any, of that gold is really there. And it may be sitting there physically, but hasn't been hypothecated and leased out. Even if it is sitting there physically, the Fed does not have legal entitlement to it. Okay? So and that's why they're not letting Congress audit the Fed, and that's why the Fed has spent a princely sum of money fighting any kind of move by Congress to audit the Fed.
Yeah, I interviewed John Embry a number of months ago, about 6 months ago, and he thinks that GLD and SLV are both basically empty now. There may be a little bit of metal there, but he thinks they're drastically overstating how much unencumbered metal they have in both, too.
I've been writing about that for a long time. I have no question in my mind that GLD and SLV are giant Ponzi schemes.
Now, my remaining questions with the miners here. We've seen a lower oil price. You cover the miners a lot. You also have research reports on some juniors that our listeners may be interested in as the gold stocks start to get some momentum. Do you think the gold miners have trimmed most of the fat in the industry and they can survive lower prices, or do you think that most of them are basically out of cash and they're going to have to start selling out companies, and we're going to see a lot of mergers and acquisitions start to pick up?
Well, there's two issues there. You know, you asked the question, are they able to survive a lower price of gold? I think it's really how much longer are they going to have to endure a low price of gold? I think gold has the possibility of starting to move up pretty quickly here. But let's take the scenario where it doesn't for whatever reason. I mean, I was just talking about this with a colleague of mine earlier tonight, which is, you know, eventually they're going to lose their ability to keep the lid on the price of gold. The question is for how long, and no one knows the answer to that question. But in terms of the durability of the mining companies, you know, again, it's hard to say. I mean, it's sort of a two-sided question, because you got the large cap producers who are still producing gold, and a lot of them are low on cash and they're poorly managed and they've taken on debt. You know, I mean, and they have, you know, even though a lot of them say they have hedges off, that's not true. Burack has hedges on. In fact, Burack's a great example of an extremely poorly managed company that you know, if the price of gold stays down here for a lot longer, they're going to run into real trouble. I do think that there are some large cap stocks that are built to weather this. I think Agnico Eagle is a good example of one. I think it's a really well managed company. I think the guy running that company is probably one of the sharpest large cap mining CEOs I've ever come across. And then you got the juniors, and I've always said, you know, I have certain criterion before I invest our fund money in any junior stock, and one of it is they've got to have enough cash to go at least a year or two without being able to raise money. And I've got some companies in our fund that they can go a lot longer than that, because they have plenty of cash, and they don't need to spend money on drilling if it doesn't make sense. So if let's say gold goes sideways to slightly up for a while from here, yeah, you're going to see some carnage in the juniors, and you'll probably see some large caps run into trouble. I think it might be a little bit easier for the large caps to get some financing because they have reserves that banks can place a value on in the ground, and they have some creative ways of financing their operations that juniors don't have available. So, I think you're going to start to see, juniors who are sitting on some interesting reserves, whether they've, have 43-101s on them or not. Some of them may just have interesting drilling results. You're going to see some of those hit the wall, and they're going to get bought up cheaply.
Yeah, I think we've already seen some evidence that that's starting to happen. I think Coeur d'Alene just took out Paramount Gold, which has a pretty large gold deposit discovery right next to the Coeur's Palmarejo mine in Mexico. I think they have 9 million ounces of measured and indicated gold, and I think Coeur d'Alene paid about $10 an ounce for the gold.
Yeah, I think that's about where deals have been going off. I don't remember.
That's cheap. That sounds cheap to me. I mean, what was the market paying in 2011? Wasn't it paying well over $100 an ounce for measured and indicated?
Well,
gold
yeah,
resources?
broadly speaking, yeah, that was about where deals were coming in. Goldcorp paid quite a bit more for an acquisition they made, but I don't remember what the name of the target company was, but Agnico bought a company down in Mexico that didn't even have proved reserves. It just had drilling results, and they paid, I think it was about a $200 million deal, if I recall.
Yeah, it was right next to their property though, so I think they were worried that a competitor would come in. Yeah, it just seems high risk, but we'll see. I think their geologists probably know what they're doing.
Right, I don't think it was high risk. I think they knew exactly what they were doing. Like I said, I think Agnico is probably the best run of the large caps at this point.
Yeah, I agree with you. I like Agnico. They're part of our model portfolio for large caps. Yeah. Besides the royalty and the non-royalty and streaming companies, because the royalty and streaming companies can grow without debt. They generate free cash flow. They have fixed costs. They don't have to bet the whole company on one mine and take out a lot of debt to build that mine. So. The regular miners have to do that basically to be in business, and do the mining business is a tough business.
Right. Absolutely.
Now, Dave, if you can tell our listeners, we're a little over 30 minutes here. You said you want to keep it around 30 minutes. I think gold may go quite a bit higher in 2015. I have a little bit higher price targets. I don't know, maybe I hope I'm wrong. I hope it goes a lot higher, but I'm trying to be conservative though at this point because the sentiment is just so negative. But I think the bear market, and we'll use bear market in quotes, the artificial bear market. Let's call it the artificial bear market then. I think the artificial bear market's definitely over in gold. Almost definitely over in gold. Barring if they actually allow a whole bunch of large banks to fail and asset prices to drop 80%, and people have margin calls and collateral and things like that, and they have to sell a whole bunch of their assets like in 2008. Not sure they'll allow another 2008 though at this point with how much money they're printing.
Were you asking my outlook for gold for 2015?
Well, you said to wrap things up, you said that you think gold's going to go quite a bit higher than most people think in 2015.
I think it could. I kind of made the mistake of there was a couple years where I didn't put any price forecasts or time frames on gold, and I put a price forecast and a time frame at the beginning of 2014, and it was a mistake. Mm-hmm. So I'm hesitant to put a price forecast and a time frame for gold for this year. I will say that really since we sort of double bottomed around the 1180 area earlier, a couple months ago or whenever it was, I do think that was a double bottom test of that sub 1200 level that we saw. I believe it was in the spring of 2013 or something. I do think that at least for now we're on a gradual uptrend, and I think a lot of whether or not that uptrend the gradual uptrend becomes more of an accelerated uptrend is going to depend on, a lot of factors. Like no one saw this SNB deval breaking of the peg coming. When I went to bed last night, gold was red, and I woke up and it was up $25. So I think you're going to see a lot of sudden surprises where, you go to bed one night and they're hitting gold in the access market, and you wake up and gold's up $25 or $50. We've already seen a couple black swans hit. The collapse in the price of oil, this SNB thing, you could categorize that as a black swan. I think we're going to start to see a lot of black swans kind of appear in the sky unexpectedly. So, and to me, that's where you're going to start to really see gold gap higher. And that's not to say they won't try and hit it again. And it's going to be volatile, but I think in general, we're on a nice uptrend. I think there's a number of factors that could turn it into an accelerated uptrend. The bottom line is, if you understand what's going on with the system, you really shouldn't be necessarily concerned with what the price of gold is. You should be concerned with getting your hands on physical gold that you have control over.
That's a good point, and I think the silver miners are in even worse shape than the gold miners because silver is actually consumed, and more than 25% of the global annual silver supply is produced by primary silver miners, and most of them are so far underwater it's not even funny, despite how much cost they've cut. So I think silver is due for a nice rebound here too in the near future out of necessity.
I have a report on my website that's It's a small silver company down in Mexico that just started producing. They are profitable down to $12 an ounce in silver, and that's all in sustaining costs. So anything above $12 an ounce, they make money. And not only that, but it also combines the attributes of a junior because they have just their existing mine. They have a lot of property that they control that they know has a lot more silver on it. And they've got some other areas that are adjacent to that particular mine that they think could be even more prolific than their existing mine. Mm-hmm. And this company, to me, it combines the best attributes of a producing company because it's now basically they produced free cash flow in their last quarter. Okay, so and that's with silver down when it was at $16 an ounce, $15 an ounce.
That's impressive.
Yeah.
Basically, no one in the silver space has been able to do that.
These guys have done it, and these are good numbers. I've chatted with management, and this is one of the most competent managements I've spoken with. And I've been doing this since 2002.
Yeah, it sounds like a good company. I know the three silver companies that are profitable that are tiny. I won't name any of the names, so I'll let our listeners then who are interested in your report. How much are your reports then?
Most of them are 25. There's some of them are 20.
Oh, it's affordable.
I've been waiting for the gold market and the silver market to rebound a bit before I put out some new reports because I still have some great ideas in the hopper, and everything I publish on we own in the fund.
Well, you put your money where your mouth is. So in wrapping up the interview, Dave, please tell our listeners more about your gold fund and also your website where they can find your articles.
Sure. I'm a managing member of Golden Returns Capital, and our primary focus is our Precious Metals Opportunity Fund. We allocate, the base case allocation is 50% of the money goes into physical gold and silver that we keep in a private non-COMEX connected depository. And then the other 50% goes into junior mining stocks. And when investors cash out, they're entitled to redeem their pro rata portion in physical gold and silver. So if someone were to cash out with $100,000 and we were 50-50 metal and miners, they would have the option of receiving $50,000 of their proceeds in physical gold and silver.
Nice.
And then my website's Investment Research Dynamics, and it's basically kind of irreverent I put together irreverent posts, and then I also have a section where I offer research reports. Right now, I just have home builder and mining stock research reports. I've actually been working on a very in-depth report on Amazon, which I'll put on my website when I finish it up, when I get some time to get around to doing it.
Great. Well, thank you again for your time, Dave, and we'll have you back on again in a couple months to talk about the real estate market, the economy, and also the gold and silver markets.
Anytime, Jason. Thanks for having me.